The second quarter of 2022 has seen markets draw down significantly on fears of higher inflation coupled with recessionary concerns. We all by now know that inflation is printing at multi-decade highs. Central bankers have no choice but to limit the impact of inflation becoming embedded in long-term expectations. The US Fed has been behind the curve on raising rates and now is accelerating rate hikes to compensate for higher inflation. Without a doubt, growth is slowing if you look at high-frequency data coming out of the Atlanta Fed. And we may find that the second quarter of 2022, the US may have slipped into a technical recession. When we cast our eyes to the east, you notice that China is struggling with its own set of unique conditions. These are both a COVID-0 policy coupled with credit issues in its property development sector. We have seen defaults in both Evergrande and some other property developers in China. And I think market participants will need to consider the longer term growth for China being sub 5% in the medium to longer term. The EU has also been struggling with low growth and goes into this cycle on the back foot, having to raise interest into an economy that is already slowing. Without a doubt, the recession in the EU has already started. Against this backdrop, what happens in developed markets affect emerging markets. Emerging markets have struggled with high inflation, largely due to imported commodity prices, which has been both a bane and a boon for their economies. Within South Africa, our inflation numbers have printed above the upper end of our expectation bands. And this is largely due to imported energy costs, with underlying inflation trajectory remaining muted. The SARB has no other option but to follow the US inflation and rate cycle. However, the SARB has started raising rates much earlier than its US counterparts. We suspect rate hikes going forward to be much more muted than its US counterparts. Against this backdrop, one still needs to make investment decisions. And when compared to developed markets, the South African market does pose some interesting opportunities, with the all-share trading at 11 times historic earnings, with muted expectations of growth, coupled with our bond market 10-year yields trading above 10%, these compare very favorably with developed markets. So for investors, we would suspect that domestic markets do offer longer-term value. However, volatility will be the name of the game in the next 6 to 12 months. But on a medium to longer-term perspective, there are many South African businesses, both in the financial and industrial sector, that pose significant value opportunities.